Hey everyone, and welcome back to the channel. Today, we're tackling a topic that many people put off, but it's one of the most important for your financial future: retirement taxes. You've worked hard your whole life to save for retirement, but did you know there might be a massive tax bomb waiting for you? By 2026, the tax landscape could look very different, and what you don't know could cost you a fortune. So, let's dive in and uncover how much you'll really pay in taxes during your golden years, and more importantly, how you can keep more of your own money. First, let's talk about the giant elephant in the room: Social Security. You might think it's all tax-free, but that's a common misconception. Depending on your combined income, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits, up to 85% of your benefits could be subject to federal income tax. Imagine getting only a fraction of what you expected. This often comes as a huge shock to new retirees, and it's just the tip of the iceberg. Next up are your traditional retirement accounts, like your 401k and traditional IRAs. You got a nice tax deduction when you put the money in, right? Well, the taxman always gets his due. Every single dollar you withdraw from these accounts in retirement is taxed as ordinary income. That means it's taxed at the same rates as your old salary. If you have a large balance, these withdrawals can easily push you into a higher tax bracket, making your retirement more expensive than you ever planned. It's a classic tax trap that many people walk right into without even realizing it. So, how do you avoid this trap? This is where the Roth IRA shines. The difference between a Roth and a traditional account is huge when it comes to taxes. With a Roth, you contribute with after-tax money, meaning no upfront deduction, but the magic happens in retirement. All qualified withdrawals from a Roth IRA are 100% tax-free. No income tax, ever. That's a massive advantage. If you're young, a Roth is often a no-brainer. But even if you're closer to retirement, converting some of your traditional savings to a Roth could be a brilliant move to create a bucket of tax-free money for your future. Now, let's discuss something you can't avoid: required minimum distributions, or RMDIS, once you hit age 73. The government forces you to start taking money out of your traditional retirement accounts, whether you need it or not. Why? Because they want their tax revenue. These forced withdrawals increase your taxable income, which can trigger other taxes and surcharges. It's a snowball effect. Your RMDIS can push more of your Social Security into the taxable range and even increase your healthcare costs. Speaking of healthcare costs, let's talk about Medicare. Your standard Medicare Part B premium is a set amount, but if your income is too high, you'll get hit with something called IRMAA. That stands for Income-Related Monthly Adjustment Amount. It's a surcharge that can add hundreds or even thousands of dollars to your annual Medicare premiums, and what determines your income for IRMAA. Yep, those taxable withdrawals from your 401k and IRA, plus your RMDIS and other income sources. Managing your income in retirement isn't just about paying less to the IRS. It's also about keeping your healthcare costs down. And we can't forget about state taxes. Your retirement tax picture isn't complete without considering where you live. Some states, like Florida, Texas, and Nevada, have no state income tax at all, making them very attractive for retirees. On the other end of the spectrum, states like California, Oregon, and Minnesota have high income tax rates, and also tax most forms of retirement income. Moving to a more tax-friendly state could literally save you tens of thousands of dollars over the course of your retirement. It's a major lifestyle and financial decision that deserves serious consideration. So, with all these tax traps, what can you do? The key is having a tax-efficient withdrawal strategy. Don't just pull money from one account randomly. The smart approach is to sequence your withdrawals strategically. In years when you want to keep your income low, you might pull from your tax-free Roth account. In other years, You might take from your taxable brokerage account and pay the lower capital gains rate. Or maybe you'll pull just enough from your traditional IRA to stay in a low tax bracket. Blending withdrawals from these different tax buckets gives you incredible control and can save you a fortune. Let's not forget about your regular investment accounts, the non-retirement ones. When you sell stocks or mutual funds in these accounts that have gone up in value, you'll owe capital gains tax. The good news is that long-term capital gains rates are usually much lower than ordinary income tax rates. In fact, if your income is low enough, you might even qualify for a 0% capital gains tax rate. This is another powerful tool in your retirement toolkit. By managing your income, you can potentially sell some appreciated assets completely tax-free. Finally, proactive planning is everything. Don't wait until April 15th to think about taxes. As the year comes to a close, there are several moves you can make before December 31st to lower your tax bill. This includes things like tax loss harvesting in your brokerage account, making charitable donations directly from your IRA, or timing a Roth conversion. These year-end moves can have a significant impact on both your current year's tax bill and your long-term financial health. Planning ahead is the secret weapon of savvy retirees. As you can see, your retirement tax bill isn't set in stone. With the right knowledge and a solid strategy, you can navigate the complexities of Social Security taxes, RMDIS, and IRMAA to keep more of your hard-earned money. The rules might change by 2026, but the principles of smart tax planning will remain the same. Start planning now, not later. Thanks so much for watching. I hope this was eye-opening for you. If you found this information valuable, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. See you next time.